take on over.
All right, thanks a lot, Delinda, for the warm introduction. And I just want to thank you all for allowing me to be a part of this special opportunity. And what I think y'all doing is truly amazing. So I'm very grateful to be a part of this. And today's topic is definitely life insurance. It is Life Insurance Awareness Month. So I would say the goal for this presentation is just to educate you on the different options you have available. Life insurance in general is one of the best ways to kind of create that generational wealth. So we want to talk to you about the different ones and how you can utilize them to create a plan for you and your family, so you can pass those funds down and give your family an opportunity to succeed in life. Because the main thing is, I'm sure we all seen it, a lot of people feel like they live life behind the 8 ball because they didn't have head starts or handouts provided to them. So we got to start thinking different and putting things in place so we can allow our kids to have a lifestyle that we always dreamed about. So I'm going to show you a couple different things about the Index Universal Life Insurance and how you can make it work for yourself. Next slide, please. All right, so Index Universal Life Insurance, just a brief overview. It's going to do two things for you. Once you purchase the policy, if you pass away, it's going to provide death benefits to your family. That money is going to come to your family tax-free. They don't have to pay any taxes on that money. So this is a form of permanent life insurance. And if you're looking to leave a legacy behind to your family, this is one of the best ways to do it. The mindset that you want to kind of be in with this particular type of policy, it's not if you pass away, it's when you pass away. So this type of policy is going to cover you for the rest of your life. So that's what it's going to do in regards to protecting your family. Now, on the flip side, it has another feature called a cash value, which serves as an opportunity for you while you're alive. This cash value is going to grow in the policy tax deferred, so you're not going to pay any taxes on that money year after year as it's growing in the policy. So kind of think of your 401k. That's another tax deferred product where it's growing every year, but you don't pay taxes on it until you actually access that money. So that concept is very similar with the cash value and how it builds up. Now, there's another feature in regards to the cash value where it has withdrawals, where you can take out either a loan or a cash withdrawal from the policy. If you take the loan feature, this is a way to get the money back out of the policy without having to pay taxes on it. So I'm going to show you a couple different ways as we move along in the slides, how you can actually accomplish that. But those are basically the two features that you have. It's going to provide that death benefit for your family, and it's going to also allow you to grow money in the policy that you can utilize later on down the road. Next slide, please. All right, so the first thing that you'll do when you think about a policy like this is you want to speak to a licensed professional to help you identify what the proper amount of coverage is. Once you figure out that, then you're going to have the premium that you're going to pay on the policy each year. You're going to pay that premium for the rest of your life, or you can design it accordingly to end at a specific age, because a lot of people don't want to pay the premium at the age 65 because their expenses are normally going to be reduced at that point since they're retiring. So you can structure it a lot of different ways. But the main concept is, as you're paying this premium, it's going to build that cash value up for you as well. So that's one thing. Think of it as almost like an additional stream of income that you can generate by purchasing a policy like this. So for an example, you have an annual premium, let's say for an example is $3,000, just hypothetically. Out of that $3,000, it may only cost $1,000 that actually goes towards your cost of insurance. That's what it's actually costing you to have the policy. That other $2,000, that's representing the cash value, which is going to be reinvested within the policy, regardless if you wanted to or not. The company is automatically going to do that. And the reason why they do that is because if you're going to pay the same premium for the rest of your life, at some point, your cost of insurance is going to exceed what you're paying in premiums. So what the insurance company does is they're reinvesting those assets. So when that situation presents itself, you can still pay the same premium, but the difference, they're going to pull it from the cash value. So that's really what allows you to pay the same premium for the rest of your life. So moving along in regards to the cash value accumulation, again, it's going to grow for you tax deferred. You know, you don't pay taxes on the money. So think of it as almost operating like a Roth IRA with inside of a life insurance policy. It's going to grow tax deferred for you. And the concept is being able to pull the money back out without having paying taxes. So those are really like the key benefits that I really want you to kind of remember about this particular type of policy. Next slide, please. All right, so what's unique about this particular policy? For one, you have the opportunity to utilize flexible premium. So for an example that I gave earlier, if you were paying $3,000 a year for your annual premium, given the current situation in the pandemic, you know, it's kind of affecting everybody at this point. So you kind of want to hold on to your money because you might need to utilize it in a different form. So the way that cash value builds up within the policy in a situation like that, where you couldn't make the premium payment for a year, that's perfectly fine. The expenses will just be pulled from that cash value. So you have flexible options, you know, from that standpoint. But now on the flip side, let's say your focus was to grow that cash value at a rapid rate. Your annual premium is $3,000. You can put, let's say, $5,000 or $6,000 into the policy in a given year if you just wanted to grow that cash value and let it back for you. So just kind of keep that in mind. I think that's very unique with the policy itself. Now, in regards to the cash value performance, how that money is actually accumulating, it's not in a fixed account and it's not in a variable account as far as like mutual funds. It's the performance is growing and it's tied specifically to an index. For an example, the S&P 500. So if you purchase this policy today, the way it works, they're going to look at the S&P 500, you know, where it's at today, and then they're going to look at it 1 year from today. Now, if the S&P 500 is positive, let's say 15%, then you're going to be credited 10% in that given year because 10% is the cap. So your cash value is going to earn 10%. So if another example, if the S&P 500 was, let's say, was positive 5% at the end of that 1 year period, then you'll be credited the 5%. Now, on the flip side, what I think is so special about this policy, let's say that S&P 500 was negative 5%. What would happen in that situation is you just wouldn't earn any money that year. So you're not going to lose money just because the S&P 500 is negative. So worst case scenario, think of it as almost like steps. It's going to go up, and then if you have a flat year in the S&P 500 where it was negative, you're not going to lose anything. You're just going to remain level. So the next year, that's when they'll look at it again. And if it's positive, then you'll be credited up to that 10% cap rate. So that's one thing as far as how the cash value accumulates within the policy. Now, accessing the benefits when you need them. So, you know, we'll look at an actual illustration so you can see how the cash value builds up. But a lot of people use the cash value for many different reasons. I mean, you can structure the policy to where you can use it to pay your kids' college education. I mean, you can structure it to where you can use it as an additional source of funds for retirement, as well as even covering a business loan. Or some people may utilize it to take care of elderly parents. So it's a lot of different things that you can kind of do with the cash value in the policy. You just have to figure out what your approach is starting out, and then you can, you know, create a plan to make it work. Next slide, please. So this is an example of a 40-year-old individual who's making a $5,000 annual premium into the policy. He's in great health. He got the super preferred rate class. And what he's doing, the way that this policy is structured is from age 40 to age 65, they're going to pay $5,000 a year. At age 65, that's when all premiums are going to stop. And at that time period, if you look at year 25 off to the left and just come over a couple columns to where it says net outlay, you'll see that they would have put $120,000 into the policy based on those $5,000 annual premiums that they pay. At that point, they have 120,000 in there. So from age 65 to age 90, they can take out a loan every year for $19,251. If you look at year 26 off to the left, they're taking out a loan for almost 20,000. That's tax free. So when I work with a lot of high net worth individuals, of course, they would put in a lot more money than this. Some of them would even do 100,000 over a 7-year period. But it's just the concept, it's going to be different for each individual. As long as you understand that concept and how you can make it apply to yourself, then, you can make this work. So in this example, they just wanted to find a way to kind of create some additional income in retirement. So they found a way to structure their life insurance policy to get 20,000 extra every year from age 65 to age 90. So I think that's one of the biggest things that you can kind of utilize with this policy. And then even from a worst case scenario, let's say that they passed away at age 65, you have 407,000 that's going to be paid out to your beneficiaries. So when you really think about it, you're in a win-win situation. Even though you put a lot of money into the policy, it's still growing and you never had to pay taxes on it. You can access it at any point for whatever reason. Maybe you just wanted to put a down payment on a new home. Now you have access to something that you can go to rather than having to go to the bank and take out a loan and pay high interest on it. You have your life insurance policy that you can utilize for that purpose as well. So it's just creating different options and different streams of income for you. Next slide, please. So just to summarize a little bit of what we talked about and a few things that I wanted you to just kind of take away with this. When is the best time to buy life insurance? And I would say now. I'm not sure what happened with the slideshow, but I would say now, because one thing about it is insurance is tied directly to your age and health. So as corny as it sounds, it's never going to be cheaper than what it is today. That's the truth, because you're never going to be younger than what you are right now. So the key is to get it when you're young, where the premiums will be a lot less expensive. It'll definitely save you money in the long run. Rule of thumb, as far as the minimum coverage amount, I would say at bare minimum, 10 times your annual income. You want to think about not just your expenses right now. You want to forecast it. You're looking at your earnings potential, your human life value. You want to allow your family to kind of maintain that same lifestyle that they're accustomed to. So 10 times your annual income is definitely a rule of thumb. The hybrid approach, we definitely have a lot of different type of policies that's going to be discussed today. In my opinion, I would recommend using a combination of term insurance and permanent insurance. I think that's the most cost-effective way to take care of your short-term and long-term needs and be covered in the best way possible. And last but not least, marijuana usage. I mean, I'm not here to judge nobody for whatever reason. I just want you to know that if that's something that's in your mind that's stopping you from feeling like you can't get life insurance or you're going to pay too much, I'm telling you right now that it's still affordable pricing that you can get for marijuana usage. They don't consider that as a tobacco rate. So, from that the standard or super standard rate, which is very common. So don't let that stop you from doing things and putting things in place to protect your family. It's always a way to kind of make something happen. So I just want you to kind of remember that, take that with you. And if you have any questions or concerns, definitely feel free to reach out to me, and I'll be more than happy to talk to you more about this or show you some different illustrations based on your personal situation. But I thank y'all for the time. It's been a pleasure, and I look forward to hearing some of the other presentations as well. Thank you.
Thank you, Chad. So at this time, we're going to open it up for any questions that anyone may have regarding Index Universal Life Insurance. I am going to mute the line, so give me a couple of seconds here, and I'll let you guys know once that is done, okay? Better yet, I think if you have any questions, you can ask me to unmute the lines. You have to bear with me. This is my first time navigating through actually having to do the back end part of the Zoom meeting. So are there any questions for Chad at this time?
Yes, good morning, Delinda. Chaz, thank you so much for the great presentation. I do have questions, but I'll only ask one question because your scenario that you put up, I mean, it sounds like a great policy. One, when do you not need life insurance? When are situations or circumstances that you may not need to purchase a life insurance policy? So as an example, I'm 43, I don't have any children, and let's say I have $50,000 in the bank. That's enough to cover my final expenses, you know, and then some, right? So
Right.
what are the scenarios when I may not need insurance, right? And then the follow-up question to that is, when I look at the example you shared, you spoke about it'll cost you $1,000 if your premium is $3,000. So if my premium is $5,000, right? Let's keep it simple math, that $1,000 over the course of 25 years, because you have 40 to 65 years, that's going to cost me $25,000 to have the life insurance policy, right?
Mm-hmm.
So can you explain how the cost benefit of paying $25,000, right, for let's say it's a $250,000 policy. I'm just throwing out numbers, you know, because that's, I think, where we see where I have a challenge I'm trying to reconcile. Do I need insurance as a single person when I have the cash to cover my final expenses? And then justifying the cost of having a policy over the course of 25 years. Sorry for if the question is complicated. Was that clear?
I might get a little bit more clarification from you on that second part of it, but let me go ahead and answer the first part really quick. What are situations where you may not need life insurance? And to be honest, I can't think of any situation where you may not need life insurance, to be honest with you. The goal, I mean, it's a given fact. You know you're going to pass away at some point. You know, and I speak to a lot of individuals with that same mindset that, hey, I got a lot of cash in the bank, or I got other investments or whatnot that I can use to, you know, pay for my funeral costs or pass down to my family. But think about it like this. What type of investments are you going to pass down that doesn't have to pay? Taxes don't have to be paid on that money. So in a retirement account, if you have a large amount in there, that money still has to be taxed once it's passed down to your beneficiaries. So it's not going to be the same amount that you see in that account. So I say that just to say life insurance is the only vehicle that's going to provide you that tax-free benefit, you know, proceeds coming to your family in the event of you passing away. So the goal is leverage that risk. You know, the risk is, you know, you're going to pass away at some point. Why use all of your money to cover that cost when you can use that same money and pay it to the insurance company? And now you then leverage the risk and multiplied it way more to be a dollar amount is way more than what you physically had in your bank account. So the goal is leverage the risk and then maximize that particular, you know, investment from that standpoint, because if you put 25,000 of that 50,000 that you had saved up in the bank, you put that into the life insurance policy, you may have a policy for, let's say, 200,000-300,000. So now you can just made that 25,000 stretch a lot more than what it was previously. So I think it's always a reason for having insurance. You know, you may not just need a lot of it if you don't have any dependents or anything at this point, but I think it's always a need for it.
Okay, thank you. I don't want to take too much time. The second question you were kind of leading into with the 25,000 is you're paying more than the 25,000 over the course of 25 years. You're paying that other 2,000, because you said your total policy cost maybe 3,000, 1,000 is going to the company, 2,000 towards your policy. That's $50,000 that you're paying for. What example amount is that policy? So if it costs me $75,000, paying 25 to the bank, to the company, and 50 towards my policy. Can you give me an example of how much insurance, just at a high profile, that may be?
Well, I kind of used the example that I had in the illustration because I kind of remember those numbers. So, you know, if you're paying the 5,000 annual premium, you would have put, I think it was 120 that you would have paid into the policy over that 25-year period, 120,000. As far as the cash value, you pretty much doubled the money. I think it was about 240 some thousand, 260 some thousand, if I'm not mistaken, as far as tax-free money. So you doubled your money within that time period. And I know you can look at it and say, I probably can double my money a lot quicker in another type of vehicle. But think about it, win-win. You got life insurance coverage that's going to provide death benefits to your family. And I think it was 400 and some thousand that would be paid out if you passed away. So the 120 that you put into the policy, if you wanted to pull the money back out, you got 200 and let's say 40,000 to work with if you wanted to pull it back out. Let's say you passed away, now you got 400 and some thousand that was being paid out to your beneficiary. So regardless of how you look at it, you still winning, even if you pass away, and while you're still alive, you're still in a better situation just by leveraging the insurance that that you purchase. I mean, it is a cost to it, but you're making money within the policy and you covered worst case scenario if you passed away. So I think in that situation, the reward outweigh the risk in that situation, and it truly does make sense to me. Does that answer your question? Robert?
I think maybe his call.
Yeah.
I'm not seeing him.
Yeah. Hopefully that answered his question, but like I say, I don't want to take up too much time from anybody else. I mean, if it's more questions, I'll be more than happy to answer them, but for the sake of time, definitely send them to me, Delinda. I'll be more than happy to reach out to an individual if they want more clarification or want to see some personalized examples for themselves. So